did I detect just a wee tension this week between, on the one hand, the markets and on the other, the Federal Reserve?
Yeah, just a little bit, David. We've seen this play before. The market gets all excited. They see a data point and they think, okay, the Fed's finally going to ease off or signal that it'll ease off. And then we get that bucket of cold water. The fact of the matter is there's just a lot of work for the Fed to do to get back to that 2% target. And, they're going to keep rates elevated and continue to raise until they have a much clearer and broader signal. And one CPI print is not going to convince them that the hard work has been done. There's just too much in terms of labor shortages right now driving wage growth for them to ease off on this effort to constrain economic activity.
So now the Fed has been fairly explicit. Why doesn't the bond market believe it?
So, I think that it's a question of what you call credibility. Is it credibility? Does the Fed have credibility that it's going to fight inflation? Or is it more that the market does not believe the Fed has credibility to stick to its guns in terms of raising rates? They're not taking the Fed very seriously, right? We are looking at what markets are pricing, both in terms of the peak Fed funds rate, which is not 5, certainly not between 5 and 5.25, as the SEPs are describing. It's below. Didn't change after Chair Powell's Q&A. And furthermore, the market's still pricing in rate cuts by the end of next year. We're looking at 4.35 for Fed funds at the end of next year. So I think the Fed has a problem. It's got its work cut out for it. Markets have been conditioned to actually not believe the Fed when it says it's going to be really tough.
So, Joanne, given this disagreement, if I can put it that way, what does an investor do? It does strike me that bonds are a lot more attractive at the end of the year than they were at the beginning. I think the yield was something like 1.8 at the beginning of the year, and we're up around 3.5 now.
Yeah, there's no question that finally investors can look to bonds to really fill an important role in their portfolios. Not only are they getting decent income off the bonds, and that's allowing them to build more balanced portfolios, so that they can both stay in equities to some degree and hopefully get that long-term appreciation that they need. But now they're getting some decent income on the fixed income side, which is a relief. Right now, real yields are negative because inflation is running ahead. But when you look to the longer term, out 2, 3, 4 years, those real yields now look positive, and they're really going to help purchasing power for those investors going forward.
So now there is a lot of volatility, though, in the bond market,
Yeah.
Is there not?
There really is. There is a lot of volatility, and honestly, until we get to a stage where the market starts buying whatever it is the Fed is selling, I think we're going to keep seeing these moves, which are remarkable. If you look at 10-year yields, which I think over the month of November went at one point from 4.25 all the way down and then back up. We've seen around 70, 80 basis points of moves, up to 30 basis points in literally days, 20 basis points in the last few. You look at this level of volatility, it's almost too much, far too much. And as I look into next year, I think it's probably going to be a few months, at least maybe a quarter or two, until we see the Fed having raised, before we see some reduction in volatility. Nonetheless, echoing what Joanne said, when you're getting yields in areas such as high yield, for example, you're getting as much as 9 to 10% on low dollar price bonds. Certainly, there are specific bonds, specific areas which look attractive, but I don't think I would go wholesale into adding risk. It's actually quite a nice time to be low in duration and high in quality in the bond market.
Well, let me pursue that if I could for a moment, Sanal. This is the end of the year, so we traditionally say, what's your conviction trade going into next year? What's your conviction trade given that volatility in the bond market?
Oh, no, I think my conviction trade on fixed income overall is high. I think I like to stay, like I said, relatively short duration, high in quality. I do like investment grade. And I think fairly soon into the new year, we're going to start seeing very attractive opportunities within the first quarter or quarter and a half. We're going to see some good opportunities in riskier segments like high yield as well. Emerging markets look very attractive too.
So, Joanne, what about you? Do you take your incremental dollar and put it into bonds right now rather than the stocks, given where bonds are? They're much more attractive than they were, as you said.
We've already seen that happen a little bit, but right now, it's not that the equity markets are particularly cheap. Volatility has been high. The bond yields are certainly more attractive. So again, a balanced strategy, at 70-30, 60-40 can do a lot for clients. And so that incremental dollar really depends on the client's horizon. Obviously, a shorter horizon client had better be more in bonds at this point, despite that bond volatility that we're seeing and likely to continue to see. And while the stock market isn't particularly cheap at roughly 18 times forward earnings, and those earnings likely to come down some more, there are still some very attractively priced stocks out there. Conservative companies that pay a dividend, that offer dividends that go up year after year. And that's another way of creating income for investors in the short term, even while equities remain a bit volatile. So if you can wait it out, you can get both the dividend income, perhaps well above the market average, to ride this out, and then still be positioned to have a portfolio on the equity side that's going to really help the portfolio appreciate over the next 3 to 5 years.
Okay, so now one quick one to you. I know you're fixed income, but do you think the equity markets have really taken into account the decline in earnings that's coming?
Doesn't appear so. So from my equity colleagues, I hear that essentially we haven't seen major earnings downgrades. Now, while I don't expect a major recession next year, some slowdown in the second half of next year is pretty much a given. So not sure that earnings downgrades have been factored fully.